The emotional cycle of investing. It's a roller coaster. You go through it. I go through it. Every single person goes through it. It's how you deal with it that matters, and how you make changes to your portfolio, if any, that are going to impact your wealth long term, because most people do not know how to play this emotional cycle, and people typically do the wrong thing. They buy at the top, they sell at the bottom because their emotions are guiding their decisions. That's why you need to take emotions out of investing. And that's why you need to focus on a long-term plan that has been predetermined so that you're not tempted to switch things right in times of euphoria and right in times of panic. So let's get into this. The first part here, midway up the cycle, optimism. Okay, so the markets are heading up. It's a bit of a good time to invest. We're kind of going through a lull here where, every month or so, markets are up a few points. There's no real bad news. You've gone through an extended period where there's no real negative news. You don't have any 10% correction. You've gone many months without a 5% correction. There's no real news, and kind of the stock market is forgotten. It's forgotten because it's doing what it normally does, which is slowly go up. The next piece, confidence. The market's going up more. Now we've gone through several years, perhaps a year, perhaps two, with no real negative news. There's a lot of confidence. You're starting to see it on the 6 o'clock news where money is being made. Investors are leveraging their house and they're putting money into the stock market because they're confident that earnings are going to be strong. They're confident that the economy is going to be strong. They're confident in employment. Let's buy more. Let's put more money in the market. The next cycle of emotional investing is euphoria. You're at or near the top. Your cousin is telling you that they mortgaged their home and they bought this penny stock or this SPAC. There's asset bubbles that are created, not just in stocks, but in all sorts of random things that are surrounding the stock market. It might be crypto in the past, but it might also be just another speculative asset class. It could be new asset classes that didn't exist in the past that are now becoming mainstream. And you can't really understand why people are paying so much money for that specific thing. Over the past years, those have been NFTs, they've been crypto, they've been SPACs, they've been penny stocks. If you go way, way, way further back in time, they were tulips. This is when humans convince themselves that there is no possible way that they will lose money buying this investment. They will tend to do things that are ridiculous, like sell their vehicles and their watches and load up on this speculative asset class because they cannot lose. Everyone is telling you that they cannot lose. This is when the maximum amount of buying is hitting the market. All the buyers are in. Anyone who can possibly be buying is in. All the dollars of the market is in. They're buying. There are no more buyers. All right. So the only individuals that are left are sellers. So once the sellers, the smart money, institutional, pension style money managers, guys like me, once we realize that asset classes are out of whack, valuations start to be non-congruent with historical norms, you start to see a little bit of selling, profit taking. And remember, all the buyers are in. So if you start to see sellers, individuals selling to take some profits, you get a pretty quick drop because there are no buyers. So you're dropping, asset classes are dropping, and the next emotional cycle is denial. And this is when you say, you know what? It's falling, but it's okay. I'm a long-term investor, just a temporary setback. Things are going to be okay. This is no problem. In fact, maybe I should be buying more because it's fallen a little bit. Market continues to fall. Market continues to fall because there are no more buyers. These asset classes, the bubbles, they start bursting. People start selling for 50 cents on the dollar, 60 cents on the dollar. Stocks are falling dramatically. Other assets that are really based on the greater fool theory, where you need someone to pay you more for your asset than you paid for it, those start to explode as well. And all of a sudden, you're approaching a period of panic. Panic is the next one in the emotional cycle. Panic is on the way down. And the reason people are panicking is now they're wondering, all right, I paid more for my assets than they're currently worth. I'm at a loss in my positions. I leveraged myself. I borrowed funds to invest. I'm really starting to worry about the asset class that I bought. Maybe I should sell the less quality stuff and go into more high quality stuff. Maybe I should sell my speculative stuff and buy some bank stocks and some safe stuff. So then you start to see a shift out of speculative and into quality. And then you get a real drop and a real meltdown in anything that doesn't generate cash flow, anything that is purely speculative. The next one is capitulation. Capitulation is right before the actual bottom. Your emotions have taken over. You're hurt. It hurts inside of you, in your heart, in your stomach. You're having a hard time sleeping because you've bought all these securities. They've fallen tremendously. And now you just don't know if you can actually even get your money out. You're worried that your life is going to be impacted. You're worried that your husband or your wife is going to find out that you did these trades without them knowing. You borrowed this money to do this. And then you're just thinking, if I quit now, if I just sell everything now, yeah, I've lost, 100 grand or 500 grand or 50 grand, but it's not that bad. I can recover and this problem goes away and I can start to sleep again and I can just remake the money by working harder, at the warehouse. And I'm going to just focus on getting out of this because I can't handle it anymore. I'm phoning my advisor. I can't stand to see these numbers down. Sell. This is the opposite of the euphoria, right? Because now everyone who wants to sell, everyone who can't stand it anymore is selling. So now we have no buyers, right? Because the market is in a free fall. It's in a complete free fall. No one's buying in a free fall, but you got a ton of sellers. And when the last of the sellers are out, when there's no one else that is selling, you guessed it, the market starts turning. The market starts turning right after capitulation and into depression. Depression is the absolute bottom right before the market starts turning. And depression is when people have finally pulled the trigger. They've sold their assets. They've now sit down in their chair and they're going, at least I'm out. This sucks. My life sucks now. I can't believe I did that. I can't believe I invested my funds that way. I can't believe I didn't have a plan. My family's going to suffer. I'm depressed. There becomes an emotional cycle where you're depressed about this. And as soon as that piece goes away, the market is now turning. We see some positive. Why do we see positive? Because the smart money, portfolio managers like me, institutions, pensions, they're buying. Why are they buying? Because they're seeing stocks trade at ridiculously low multiples. They're likely buying quality stocks first. So they're buying assets that have strong balance sheets, good management, good cash flow, and they're buying those companies. And as they're buying those companies, if you have more buyers than sellers, now remember, we're at the opposite of euphoria now. We are at the bottom. There are no sellers, right? All the sellers are out. Everyone who wanted to get out is out. And the only people that are left are individuals that are going to be long. They're going to keep their shares no matter what happens. So they're of the kind that are saying, it's going to be what it's going to be. I'm in it. I'm in it for whatever it is. Well, those people are staying put. Smart money's coming into the market. You're now seeing buying pressure. So one day you're up 300 points. The next day you're up 500 points. Then you're up 1,000 points. Then you're starting to see the news on the 6 o'clock news, stock market turning around. Markets are up. Portfolio managers excited about the future. And then you're starting to see surveys saying that the stock market could reach new all-time highs. And boom, more and more buying. That spurs more buying. The individuals start calling their portfolio manager. And then there's a period there where it's reluctance. You know what? Things are turning around. The individual who sold all their assets, things are turning around. I think if I would have just stayed in, I think I would have been okay. But you know what I'll do? I'll wait to see if it lasts before I get into the market again. I'll wait to see how long it's going to last. And, let's see how this plays out because, you know what? I don't want to get burned again. If this is a dead cat bounce, I don't want to be caught in it. I want to make sure that this is going to go for the long run. So then what happens? More and more buying. Stocks are trading at a discount. We see buying, we see earnings, we see the economy, the job numbers are solid. The cycle is rebounding, and then we're back into optimism. You know what? This market is rallying a ton. I should probably invest. There you go, guys. Optimism, confidence, euphoria, denial, panic, capitulation, depression, reluctance, optimism. That's your cycle of emotional investing. If you'd like to find out more about this or you'd like to discuss, book a no obligation consultation. Go to www.speaktorob.com. We manage money for a living. I'd love to chat with you about this or anything else. I'm Rob Tetrault, guys. See you in the next video.